Hey, Roger here, and we're coming back at you with another video from the Life Insurance Academy. And today we're talking about how to use life insurance as a tax-free retirement strategy for your clients. Have you ever thought about that? We're going to be discussing that in this video. If you like this type of content and you want more of it, I would ask that you subscribe, that you would like it, that you would share it, and also check us out on Spotify or Apple Podcasts, wherever you listen to the audio version of these podcasts, and subscribe there and share. All of that helps us with this channel and this content. We also love to hear your feedback. So let's jump in. Life insurance can be used for a tax-free retirement strategy through a cash accumulation policy, such as a whole life insurance policy or a fixed indexed universal life policies. These types of policies provide a death benefit and a cash value component that grows over time. So here are some steps to use life insurance as a tax-free retirement strategy. That word's coming up, tax-free. We're going to talk about that in just a second. But first, we're going to purchase and commit to funding a cash value life insurance policy. So we're going to look for and set up a whole life insurance policy that builds cash value over time. To maximize this strategy, we're going to elect to do the opposite of what most people think of when they think about buying life insurance. Most people see these ads on TV, maximum death benefit, minimum, premium contribution. You can get $500,000 for $15 or $29. Those are the ads we see. In this type of strategy, we're talking about using the provisions inside of a life insurance policy for other reasons other than just a death benefit. It will have a death benefit, but it's going to have some other massive benefits that are associated with it. So to maximize this strategy, we're going to elect what most people don't think of. And we're going to elect to choose the minimum death benefit and maximum cash accumulation into the policy, so that when we're setting it up, it has an opportunity for you to fund that cash accumulation portion. So a portion of your premiums are going to go toward the death benefit, and the remainder will be invested in the policy's cash value account, which grows tax deferred. That's the first part. Number two, we're going to maximize the contributions to the policy. So unlike other retirement accounts like a Roth and things like that, where you may have limitations based on annual contribution amounts that you're allowed to put in, or an IRA or a 401k, there are really no contribution limits on a cash value policy. You can set it up and design it the way you want it to. And if it's properly funded, you can actually set that policy up so that it can be funded all the way up to what's called the MEC ceiling, which is a ceiling which then loses the benefits of the policy. So we're not going to supersede that. And MEC really is a short for Modified Endowment Contract. Those are some details inside the policy. We can get into that later. But it's important to contribute as much as possible into the policy each year while maintaining the provisions and the benefits inside of that policy to maximize the tax-free growth potential. And then lastly, we're going to access funds from the policy tax-free. What does that mean? Well, once the policy's cash value is accumulated, you can access and use the funds tax-free in the form of policy loans. We're not going to take a distribution. If we took a distribution, it's going to trigger an income event. That's going to be considered income. We're actually going to access the money in the form of a policy loan. A loan, by definition, is not considered income. Therefore, you'll not have to pay taxes on this money. And you can use these funds for other business investments, for supplementing your retirement income with regularly scheduled loans, maybe at 6-month intervals or annual intervals, or you can pay for long-term care expenses or any other financial needs that you might have during retirement. And if the policy is properly funded, it can be set up in retirement to pay you a predetermined regular annual lifetime income. The loans are paid back upon death when the death benefit is triggered. So what that means is that you don't actually have to pay back the policy loans if it's set up properly, because the cash value is going to continue to grow with the dividends and or the interest rate that's being paid on the cash value. It's going to continue to grow, and you can access the funds in the form of retirement income. And when you die, that's when the death benefit is going to be paid back. So the loan is satisfied first upon your death, and then any remaining benefit is then paid out to your designated beneficiaries tax-free. Now, let me ask you a question. If you present this strategy to your clients, do you think there might be some interest in understanding how life insurance can be used differently than just for a death benefit? Using life insurance as a tax-free retirement strategy can provide a reliable source of income during retirement while also offering the protection of a death benefit for your loved ones while you're living for the uneventful thing. It can also be used, of course, for things like critical illness or chronic illness if it has living benefit riders attached. So a policy like this really is a high-powered product that once you learn about it, you can present it to your clients with authority, and it's amazing the benefits and the attention that you will get and the interest you will get in letting your clients know all the benefits that are included in a product like this. So when we consider the costs and benefits of a cash value policy, you have to measure that against other things that they're doing. So if you're presenting this type of product, make sure you're fully transparent about the upfront costs, generally in the first 2 years of a life insurance policy, but then show them the projections, show them how that's going to perform over time. And over time, those costs become very, very minimal. It's important to have a good strategy going in. It's important for you as a new agent, if you're working with a group, to consult with somebody who is a specialist in this area, who does a lot of this, so they can help you understand how to structure these types of policies and this strategy correctly. But man, what a powerful strategy that this is for people when it's presented properly and when you understand how to make this work. So I hope this helps. I hope this is just another way for you to generate great income in this unbelievable business of life insurance sales.